Poland moves 1 in 5 trucks on European roads. Every 5th shipment crossing EU borders. Every 5th load connecting Germany to Spain, France to Romania, the Netherlands to Czech Republic. Polish carriers are not a part of European freight. They are European freight. And right now, 3 separate cost shocks are hitting them at the same time. Not 1, 3, simultaneously. If you were buying freight capacity in Europe right now, and Poland is anywhere in your supply chain, what happens to Polish carriers in 2026 is about to show up in your rate negotiations, whether you plan for it or not. Stay with me. Cost shock number 1. Driver cost. Poland just implemented the largest historic increase in the ZUS social contribution base for international drivers. ZUS is Poland's national social insurance system. Think of it as the mandatory employment tax every carrier pays per driver. The contribution base jumped from 8,673 PLN to 9,420 PLN. That's an 8.6% increase per driver per year. Sounds manageable in isolation. It is not in isolation. Eurowag data shows ZUS charges alone rise by 313 PLN monthly per driver. Combined with income tax advances, the employer cost increases by 321 to 322 PLN. The total cost of maintaining a single driver now reaches 13,668 PLN monthly. A fleet of 10 drivers, that's an additional 3,860 PLN per driver annually. Nearly 40,000 PLN extra per year before you touch anything else. Polish carriers are already signaling freight price increases of 2 to 5% on European lane. Cost shock number 2. Toll. February 1, 2026. Poland implemented a 33% base rate hike on road tolls and added 645 kilometers of new tolled roads to the network simultaneously. Tolls already represent 14% of total freight costs on European lanes, according to Giedricke data. A 33% toll increase on top of driver cost increases is not additive, it's compounding. Every kilometer of Polish road freight is now more expensive than it was in January. For carriers routing through Poland, which is most of Central European freight, that cost difference goes somewhere. It goes into your rate. Cost shock number 3. Tachograph. From July 2026, all vans up to 3.5 tons operating in international freight must install second-generation smart tachographs. Hardware costs €1,000 per vehicle for purchase and installation alone. Then driver cards, company cards, staff training, procedure updates, software for data reading and archiving. For a small Polish carrier running 20 vans, that's 40,000 to 60,000 PLN in compliance investment before July. And Poland has tens of thousands of small and medium carriers. The ones who cannot absorb that investment are already making decisions about whether to stay in the market. When small carriers exit, capacity tightens. When capacity tightens, rates go up. Not for Polish carriers, for you. 3 cost shocks, 1 year. The carrier network that moves 20% of EU freight. And right now, the carriers absorbing all of this are not charities. Every zloty of additional cost finds its way into a rate card eventually. The only question is whether you find out through a cargo intel video or through your next freight invoice. The operators who are already renegotiating their Central European contracts, who are building the new cost reality into their 2026 planning now, rather than reacting to it in Q3, are going to be in a fundamentally different position from the ones who waited. Poland did not slow down. It got more expensive. And that difference is already moving through your supply chain. Cargo intel every week. Subscribe and share this with someone routing freight through Central Europe right now.